From tightening fiscal space to job losses, this is indeed a tough time for the economy. Will it be able to weather the turbulences and register impressive economic growth in the year 2019? Well, according to the expert, a lot needs to be done.
This tells us we are heading towards difficult times. The cost of living is going up, unemployment is going up. Only this week we saw Stanbic announcing 200 employees may be laid off, EABL announcing about 100, Telecom Kenya saying 72% of its labor force might be shown the door. So it tells us as an economy, there could be areas of growth, but it's not being felt across the board, and that should be a point of concern.
The Kenyan economy expanded by 6.3% in 2018, according to the Kenya National Bureau of Statistics. This has prodded the National Treasury to upscale its projection to 6.5% this year on the back of improved rainfall and better macroeconomic prospects. However, a lot seems to be going against this projection. Already, the government has embarked on a major fiscal tightening by freezing capital expenditure on new projects, while limiting capital expenditure to only ongoing projects.
So you have tightening from the fiscal side and tightening from the monetary side. And when you combine these two forces, it will lead to a very tight liquidity scenario, which is bad for economic growth. And that's the reason you're seeing businesses are shutting down and people are being laid off.
Chief Economist at Mentoria Consulting Ken Gichinga says the government should lift the freeze and review the interest rate cap low to stimulate lending to the private sector and boost money supply. According to the Kenya National Bureau of Statistics quarterly growth report, the economy in the January to March period expanded by 5.6% from 6.5% a year earlier, highlighting a difficult economic environment. Gichinga says the growth is further compounded by slow credit uptake and the weakening of the Kenyan shilling.
The CBK can continue mopping the shillings like they've done so far, about 45 billion, or they can continue selling dollars into the market. The question is, do we have a diverse source of dollars? Because the key main dollar earners for Kenya are remittances from the diaspora, horticulture, tea and coffee. If these sectors are not, and tourism, if these sectors are not changing fundamentally, it means really they have to continue mopping up the excess liquidity in shillings.
3 companies have so far announced plans to lay off staff, casting doubt on Kenya's economic health. But Gichinga says the government can wiggle out of this hair-raising environment by implementing various measures.
Let's actually start spending. That's Keynesian economics. When your government spending goes up, aggregate demand goes up. So that's called a fiscally expansionary policy. Number 3, it would be looking at the labor market again, asking ourselves, are the young people being employed in the sectors that can absorb a lot of people? I think if you do those 3 things alone, you'll see a far more vibrant economy where money begins to flow.
O'Brien came in for Business Insight.